Hi everyone, this is Rob Roy of Elliott Wave Options and welcome to TradeFinder Live. For those of you that are either new with us or have been with us before, you know the protocol. If you are new, then we have to go through this disclosure/disclaimer each week, and I will highlight the pertinent information for you, but take a screenshot of it, look at it at your leisure. Basically, the important things to know is that we are not registered to give individual investment advice in the United States, and any pricing that we talk about is denoted in US dollars unless we tell you otherwise, or soon to be denoted in US dollars unless we mention otherwise. But if you are new with us this week, welcome. And again, take a screenshot of that, read the whole thing in its entirety at your leisure. Just to give you a rundown of how we do things here is, start off, I'll go through a few minutes of what's happening in the market. I usually don't move into the currencies, but the dollar had a pretty rough day today, so we'll talk about that. And then we'll take a look at any case studies that we may have closed on our website for our subscribers. We'll go back and take a look at some of the ones that we have done in the past, as well as specifically what we looked at last week. And then we will look to see if we can find a case study for our consideration for this week. We like to just, put everything out there and full accountability. And if you're with us each and every week, you know the alerts that we've been sending out, and we've had a pretty darn good record. So we're not doing any sort of back testing case study type of thing. Everything is right in front of you. You're seeing the searches live, and anything that we would consider worthy of your consideration. And then at the end, if there's any time left, I'll take some questions. Please feel free to go ahead and ask your questions throughout the course of the webinar. I won't answer them during. Support staff is here. They'll do a great job of answering questions that they can. If there's anything that is directed specifically to me or a question they deem that I should answer, again, I'll get to as many of those as I can at the end. And please, if we don't get your question, join us again next week, and we will certainly do our best to get to you then. So with that said, let's go ahead and move forward, and I'll bring up the chart of the market. A couple things to note here is we're right at that previous wave 3 high, and we're at a 38% fib extension. So if we look at this in the last YouTube recording that we did, we talked about how we were right here at that previous wave 3 high with our, so we look like we're in decent shape to make a run towards that wave 5 high. And don't forget, with our really cool new, just got to note that the internet connection was possibly a little bit shaky. So sorry about that if there was any sort of an issue, but looking at the current chart, we came back down, tested where the breakout point was. Now the key will be what happens in tomorrow's trade. Do we break from here and move to a follow-through day, confirmation day, and head up to that wave 3 high? And then I wanted to show you, based on our zigzag tool, a reminder of this zigzag pattern that has the C wave extension right here, right in the area of the wave 5 potential target. So two different Elliott wave patterns, the full 5 wave motive pattern, if you will, and then the impulse pattern, zigzag, starting at the low from the 14th of May. And it's not just because that is the low there. That was the completion point of a previous zigzag, an extended zigzag that completed itself here. And we pulled back and we started a new impulse run. We are going to have our new educational course on Elliott Wave in the not too distant future. I'm going to talk a little bit more about education here in a little bit, but please join that course if you have any sort of confusion, which is a common question of where do we start drawing things. It's nice when the software draws things for us, like the 1, 2, 3, 4, and 5, but when we start with the zigzag pattern, etc., where do we actually start the draws? Where does the impulse start, etc.? So we'll cover all those types of things. But at this point in time, it still looks like we want to go up and make new highs. And can you imagine what will happen in the media if the market makes new highs with all of this stuff that's going on. And I live in Florida. And you know, if you listen to any news, it sounds like the entire state of Florida has the virus. More cases every single day showing up in record numbers, et cetera. It's not quite that severe. I can attest to that fact. But the fact is, if we were to make new highs in the market with everything that's going on, you can imagine all of the splash that's going to get through financial media outlets. Markets at a new high, et cetera, trying to draw in the money that's still on the sidelines. And if you haven't been listening to the recordings in the past, pardon me, the way things work as far as professional traders is when all of that retail money starts to come in, that's when the smart traders start to sell. So that's why the smart traders came in down here when it was all doom and gloom in March. They've ridden this move to the upside, and they'll be looking for an appropriate exit as the market moves to a new high. And what an opportunity that would be. Stock market at new highs, even with all this going on, how strong, I mean, you could write your own headlines as what will occur in the marketplace if that were to happen. I do want to show you this, and I usually do things like this in the YouTube recordings, but just because today was such a bad day for the dollar, I wanted to share this with you. And we did show this in the last YouTube recording about how we had a wave 5 down pattern in the dollar, but look how bad today was. Today was just a big move lower and the exact opposite of what is occurring in the equities market. So we looked at the S&P, how we broke above that recent wave 3 high today, again, gapping up on the open, but filling the gap throughout the trading day. Exact opposite occurring with the dollar, breaking that previous wave 3 low as we look to move down to that wave 5 target to the downside. Now, if the dollar were to move down to this target price, that's probably supportive of a move higher in the S&P. And the reason for that is it helps international companies, right? Because of the exchange rate, et cetera. So weaker currency, it's good for profits for international companies. You just don't want the dollar to get to the point where it starts showing a lot of economic weakness. So a weaker dollar is okay, but if it gets to be really weak, that's not okay. And I know that sounds like a fine line, and it is a fine line, is that they want the dollar to be weaker, but if it goes too far down, like if we were to extend this move, because we're not that far away, so on a move lower to the wave 5 target to the downside, and the dollar, again, would pretty much correspond with a wave 5 target to the upside in the market, but we'd want it to hold there and then do its retracement when a wave 5 pattern completes where it retraces to the previous 4. That would be ideal for showing that there is some sort of underlying strength to the economy, even with, we talked about, we didn't talk about this, but United Airlines announcing today that they reported a multi-billion-dollar loss for the quarter. And President Trump came out and said the virus is probably going to get worse before it gets better. That's kind of stating the obvious, I think. But there's just an awful lot going on that could cause the dollar to destabilize further. And with all the stimulus that has already been injected, with the amount of liquidity that the Federal Reserve has injected, and now they're talking about, it looks like the latest data from the two primary parties saying that we're probably not going to pass a new stimulus bill through Congress in the month of July. But I think it's a pretty good bet that there's going to be a new stimulus package, possibly in August, maybe September. We'll see how that plays out, or maybe the election starts to play in and it becomes a political hot potato as far as whether or not we get another one or not. But I think that there's a pretty good percentage chance that we are going to get one. Can you imagine what that's going to do to the dollar if they create even more money out of thin air, which that's the problem with what's occurring to the dollar now. And a lot of people are watching the dollar, which is why I wanted to share it with you. A lot of people are concerned about the fact that we already had a debt to GDP. I've covered that several times in our YouTube videos, above 100, and meaning that we're living on credit cards already. And now we have all this stuff, and we're just printing more money from the stimulus from the Federal Reserve. Where is that money coming from? It's not real. Anyway, we'll cover that. We'll have that conversation another time. We'll get into a Federal Reserve. We've talked about this numerous times. A lot of people ask questions about it, and we'll cover that in another webinar. So that's where we are in the market. I did want to share with you a alert that we closed for our subscribers on Monster, MNST, and I wanted to spend a minute or two to talk about this one because I find it a pretty interesting case study. As far as we all know, trading is risk versus reward, right? That's what it all boils down to. So back on May 27th, we sent out this alert, and you can see it was a call spread for the month of September, a call vertical debit spread. And when we bring up the chart, here's the chart that we were looking at, and we had a potential price target around 73 plus to 75, somewhere in there, which would be the wave 5 target. We were in a wave 3 to the upside. The DMI was looking good at the time, so the expectation of a continued move higher was there. Remember that the difficulty in trading the wave 3 is when does the wave 4 begin. We do look to the DMI to give us an indication that the wave 3 could continue. So we look for our confirming indicators along those lines. And you can see the stock was actually marching right up along that 45-degree angle, that dotted line, indicating where the C wave extension would be. So it looked good to send it out, and we did. And then we just exited that one yesterday. And here's the chart of why we exited. So we were looking at a doji. We're at our price target. As you can see, we're trading right there at 75. So that was the price target that we had originally set in place. If the stock hits your price target, and then you're looking at a doji, and look at the volume. There was no volume yesterday. So it looked like, okay, this is an ideal time for the stock to potentially move back down. And the other consideration is, again, the stock's at 75. Remember the spread that we had. Now it is September, so there still was some time, but it was a 70-80 call spread, which means the long call, the 70 strike call, was 5 points in the money. So if the stock were to pull back, which it did today, it pulled back over $1 today, but if it were to pull back, almost every amount of a pullback comes right off the top as far as the profit is concerned, because the lower strike is so far in the money. If you're still out of the money, then maybe you consider, okay, we'll just hang in there. If we get a little bit of a pullback, no worries, we still have plenty of time. But you have a different risk to reward scenario. You have a different risk to reward scenario when you have a spread where the lower strike is 5 points in the money. Now notice that the wave 4 was formed, because remember, on the entry we were still in the wave 3, and then we came back, we formed the wave 4. It took a while to get to the wave 5 target. It took longer than we thought to get there, but in the end it got to the exact point we thought it would. It just took longer. So at this point in time, are you going to hope that it continues higher from here, which it could? It's only a 40% wave 5 extension. So you could look at that and say, well, I mean, it could easily go to the 61.8% fib extension. Another 20%, that's not out of the realm of possibility by any way, shape, or form. But when you're looking at a doji, so there's indecision here. We just broke to a new high, very little volume supporting the move. You're at your price target. All those things add up to, it's time to take your gain. And that's the benefit that our subscribers have on that kind of analysis for exits, not just entries. Because again, just looking at the Elliott wave chart, it would have been easy to say, okay, we have more room to run. And maybe in the end, the stock does run higher. Who knows? Maybe it does. But at least for today, it looks like we did the exact right thing for getting out yesterday. And had you waited a day, you just gave back a big chunk of the 35% profit that we made already. And because of the excess time, it took that lower strike being that far in the money to make the 35%. So all in all, we did the right thing. And I just wanted to share that analysis with you because there was a lot of consideration that went into when to take that exit, when to take that profit. And you can see that from our dot plot chart here that we were at a loss for a while, and then we broke back up, came back down. So this is really cool. These dot plot charts that show you the profit and loss on every position from entry to exit. So while we're talking about the website, I did want to share this with you because I think that what our subscribers enjoy from just the alert service and the analysis that I just went through, if that's all we did was the alert service with the analysis that went along with it, I think our subscription is a tremendous bargain. But we do a lot more. We have all this education that's on our website as well, and all these programs that you can see are in depth, and you can see the prices, the number of lessons, like on the trade scan course that we went through. We also have our Elliott Wave core, 17 lessons so far. You see all these things and the prices that the public pays. All of this education is 100% free for our subscribers. They enjoy all of this completely free of charge. And so if I click on one, and you can see all of the courses that come up, and we actually have some of them are designed where you're not allowed to go to the next section until you've looked at the previous one. So maybe there's something that you want to look at and you're interested in it. Great, we want you to do that, but we also want you to utilize the education properly and what it's designed to do. Educate yourself on what we do. Why do we use Elliott Wave? Why are we so focused on it? Why have we been trading it since 2001? All those things, we want you to fully understand it, and then in the end, see why we've achieved the results that we have. So I just wanted to share with you, I hadn't showed you this before, the fact that there's so much more to what we do at Elliott Wave Options than just an alert service. All right, so there's the dollar, here's the S&P, and let's go ahead and take a look at a few of the charts that we have looked at for case study considerations in the past. Oh, by the way, I did want to show you that we closed out a couple other positions yesterday as well. I highlighted that one that we did on Monster, but we also had a bullish trade on FSLR that we closed out to the upside, and then we had a strangle on checkpoint, and you can clearly see the breakout that occurred there, and that was a nice exit as well. So we actually sent out 3 exit alerts yesterday, but I don't want to go through each one of them, spend all the time on doing each individual one. Just let you know that we did do several things. If we don't close out anything this week, then I'll focus on the particulars of one of those in the past. But so yesterday was a pretty profitable day. So let's look at what we did last couple of weeks. We looked at Clorox a couple of weeks ago, and it has kind of just stabilized a bit here, but you can see why. And it's 97% extension. We looked at that one 2 weeks ago, so I don't know if you'd still be involved in that or not. That's the tricky part, isn't it? When you get in, where do you take your profits? How long do you stay in a position and take your gains? That's where we help guide our subscribers. And that monster trade, by the way, was also one that we had looked at a while back here in TradeFinder as well, which we chose to send out to our subscribers. And then last week, I believe we looked at MAS. And that was a heck of a week in MAS. So hopefully you follow that. Look at that move from last week. So today's the 21st. So let's walk that back. That's where we were last week, trading at $51 a share, and then move it forward today, $53.90. So a pretty nice move over this week on MAS. Again, you know, how much profit do you want to take? Let's look at the 10-day moving average here, because you see this is a little bit of a similar scenario that we just talked about with Monster. We have a doji here, and we're also a bit overbought. If you're new, you're going to hear me say this numerous times. If you've been with us before, this is probably the 100th time you've heard me say this, and it won't be the last. No security in any time frame gets very far away from its 10-day moving average, period. They just don't. And so here we have a doji. We're starting to get some separation from its 10-day moving average. Maybe this one has a little bit of a pullback within the next day or two, or maybe it just goes sideways. But you can clearly see what occurred here as the wave 3 moved right to that previous wave 5 high, and look at how many days it traded right through that area. Support, resistance, old-fashioned technical analysis here. So resistance, boom, resistance, resistance. Oh, we broke above it. Is it the support? Maybe not really. Broke above it, and now we're off and running. So a major support and resistance point right there at 50. Now we're starting to move and put some distance there. The DMI still looks good. So that still looks pretty impressive if you hadn't exited yet. But if you're following this one and you're still involved in it, don't be surprised if it pulls back a bit over the next day or two, or goes sideways and allows the 10-day moving average to catch up, because that's what occurs when you get the separation between where the stock is trading and the 10-day moving average. Either the stock pulls back towards the 10-day moving average, or it goes sideways and allows the 10-day moving average to catch up, a la the Clorox chart, where it ran up and then went sideways. One of those two things occurs, but the separation from where the stock is trading and the 10-day moving average does get rectified. And that's the same whether it's below the 10-day moving average or above. So if the stock is breaking down, like a lot of them did in the March timeframe, from February to March, when the whole coronavirus thing really took off, a lot of stocks tanked hard. They got away from their 10-day moving average to the downside, and they came back. And in this case, you can see where it went sideways, bounced back up, consolidated, bounced below it, bounced above it, and then it was a different scenario. So the stock was below the 10-day moving average through the better part of March and April, or excuse me, February and March. And then when we went into April, we moved back above it to where the stock was primarily above the 10-day moving average. But my point is that the separation is the same whether the stock is above the 10-day or below it. It just doesn't get far away from it. So that looks pretty good from our case study last week. I did want to show this one, not to highlight anything negative, but it's the only one since we started doing these trade finders that gave us problems. And look at that. So the one case study consideration that we've looked at for the past several months since we've been doing Trade Finder, the one case study consideration that had pulled back, that was giving us problems, has now exploded back to the upside and is above where our entry would have been. So the one problem child is now in a wave 3 to the upside. So no longer a loser. And again, at what point in time do you want to look to exit this? You can see, just like we just showed you with MAS, pretty good separation between where the stock is currently trading and the 10-day moving average. So we just broke above this recent high here. Maybe we need to come back and trade through that a little bit. We had the doji right there in yesterday's trade, broke above it today. But that separation there would be a concern. But isn't that interesting that the one that we would look back on and say, this is the one that didn't work out. We had the one that didn't work out. Well, now that one has. So really, we haven't had a losing case study consideration in all the trade finders. So if you're new with us, you found a good place to come and look for potential case studies. And if you want more information, then obviously we can add you in as a subscriber, and you get the full alerts and education, etc. So let's go ahead and take a look at our pre-computed scans. This is another feature that's free for our members, is that you have the searches that I utilize. If you are a ProfitSource user and an Elliott Wave option subscriber, then you get these searches that are included with the program. So they're right there for you. You don't have to input all the individual parameters, any of that stuff. They're pre-computed, they're set, they're done for you. So we have several here. We have 2 that are in corrective patterns, 8 that are in impulse patterns. Now notice that the number of consolidating stocks has dropped. If you've been with us the past couple of weeks, you know that number has been more like 350. But that was because at that point in time, sorry, clicked the wrong button there. At that point in time, the market had been consolidating. So it made sense that we had a lot of stocks that were consolidating. Well, now the market's breaking to the upside. So it's breaking out of that consolidation, and you're seeing that with the number of results that are showing down to 274, still a lot. So, I mean, you know, we haven't made a significant break in the market, but down from the 350 that we're seeing, 330 to 350 that we'd seen over the previous couple of weeks. So that makes sense. The market's starting to break from its sideways move. So we have fewer stocks that are actually in consolidating patterns. So let's click on the bullish search here. There's 8 results, and we take a look, and the first thing I like to look at is, are there familiar names there? And again, if you've been with TradeFinder for a while, you've heard me talk about Google, that over the time that I've been trading Elliott Wave, Google is probably the number one. I don't think there's really any doubt about it. I shouldn't say probably, but very likely the number one stock that I've ever put positions on. It just shows up in Elliott Wave patterns. There's a couple others that I want to look at. Alibaba, McDonald's, we certainly want to take a look at those, but let's just go ahead and click on Google. We had a position in Google that we took for a profit, and maybe we're looking to a point where we can enter another one. Maybe Google is not done running yet. So let's take all this stuff off here and take a look at where the current pattern is. Turn the Elliott Wave on. Here we are, right at the wave 5 target at a 59% extension. So call that the 61.8% fib extension, also hitting its wave 5 target. So where we talked about with the market itself, 2 different Elliott Wave patterns, the 5-wave pattern and a 3-wave zigzag, showing us roughly the same profit target or upward price target. Now we have, with Google, 2 different patterns showing us that, you know, maybe we're at a point of resistance here, the wave 5 target and the 61.8% fib extension target. So, man, a little bit of separation there with the 10-day moving average. Be difficult to commit to adding a new position on Google in tomorrow's trade. You would kind of want to see this gap here close down a little bit to the downside. Looking at the DMI looked pretty good from the chart that I showed you before that had all the indicators on it. We already knew that the DMI was going to look pretty good. There's really good separation between the 2 directional indicators. The ADX is moving up. It's telling you that there is strength to this move. So what the DMI is saying is that we are likely to move past that 61.8% fib level. That's why we have the confirming indicators. Because what do you do in a scenario like this? Are we done? Do we just walk away from Google? Do we forget about it? It hit its wave 5 target. It's at a fib resistance level. You know, do we just forget about it? Well, the DMI is telling you, hey, there's a good chance that we may move past that up to the 100% extension level. And from that standpoint, maybe we want to watch it. But do we want to do anything tomorrow? Not really, not until we see that. Maybe it just takes a day or two for Google to kind of churn in a bit of a sideways pattern to let that 10-day moving average catch up. Maybe on the low tomorrow, it comes down and closes that gap. That's, in my opinion, one that goes on the watch list that we keep an eye on for where it sits over the next couple of days. And you might look, and this would actually be a valid argument of maybe you're trying to get a little too perfect on your entries. That's, again, a valid point. But I just think that when we look at those, the 10-day moving average is just so accurate as far as the separation, as stocks not getting far away from it, that why throw money away chasing a stock that's showing itself to be just a little bit overbought short term, when we could very highly likely get in at a slightly better entry? Now, do we miss some because we do that? Yeah, because stocks can get overbought or oversold and stay that way for periods of time. It's not a long period of time, but they can stay overbought or oversold for periods of time. And, we could look back and say, well, that would have been a better entry than, where we are 2 or 3 days from now. But that's a very small percentage of the time that occurs. I try to give you both sides of the argument, understanding that no technical trading system is right 100% of the time. No person, including myself, is right 100% of the time. We're wrong, and we have to be willing to admit when we're wrong, or you're not gonna survive very long in this. If you can't lick your wounds and say, I missed that one, I was wrong, or the indicators, that was one of the smaller percentages of time where the indicators didn't come through. If you can't admit that and then adjust and move on, you'll eventually get wiped out. It's just the way it happens. So let's put Google on the watch list and go back. Let's look at Alibaba. We do currently have an alert on Alibaba for our subscribers, and we'll take all this stuff off again, and I'll bring the DMI back on in a second. But there is the pattern. You can see it's in a wave 3. Note that we had this big explosion to the upside. This is why I don't like the vertical moves. This is exactly why I like a 45-degree move. So I prefer when stocks do that rather than this vertical move, because the 45-degree angle ones tend not to do this type of thing where they correct hard. In this case, Alibaba had a vertical move. We took it to 10-day moving average, and let's just walk back. Let's just walk back here. There you go. There's where the stock was trading. There's the 10-day moving average. This is a perfect illustration of what I was talking about. In fact, that stock is overbought. So we move forward and boom, there we go. So what did it take? 3 days. Now we're back to the 10-day moving average when you look at it. And then back we go to the upside. We're slightly overbought right now. Not as bad as it was back over here on the 9th. But we're right back up there. We're in the wave 3. This correction was not enough to label the wave 4. So we still, at some point, will have a wave 4 correction. It's not there yet. This move down just did not signify a corrective level, but it certainly looks like that we've had a zigzag move from here. So let's use our zigzag tool. There you go, 50% corrective level. Look at this. Check this out. There's your wave 5 target at the 100% extension, right smack through where the wave 5 potential target is. So here, like the market, we have 2 different Elliott wave signals giving us the exact same price target. And I did not pre-look at these. I don't do that when we do TradeFinder. I wait. This is what I do every night, though. I mean, what you're seeing in the TradeFinder class every Tuesday night is what I do every night on my own. But I wait on Tuesday nights to do it with you. So you're seeing things as I see them, and I'm not going back and looking, re-showing you what I've already seen. We want you to hear the thought process and as live as possible, since we call it TradeFinder Live, to hear the thought process as real as it is. And so I had no idea that zigzag extension was right smack there, but it is. Two different targets telling us 292. Well, then it comes to, well, if the stock's going to go to 292, are we really going to get that close to 300 and not hit 300? You know my feelings about the big whole numbers. They act as magnets where they just seem to draw stocks to them. The 300 level is still within this window of the wave 5 target. the 300 there. So I think there's a good chance that we trade past this 292 level and possibly up to 300. We're currently trading at 257 on Alibaba. Maybe a tiny bit overbought, not a whole lot, but a tiny bit overbought right now. But certainly looks like the potential is there for that to hit 300. So that looks pretty good. And then going back, the other one that I wanted to look at, well, Accenture has had a pretty nice move as well, but I want to look at McDonald's. If you've driven around lately, you know that fast food is doing really well right now because people don't have to get out of their cars. Now that could just be in Florida. I don't know if that's occurring in other states, but you know, with all the daily bombarding of news that we have every single day about the virus cases here, you drive by pretty much any fast food place and there's a line of cars there. But before we look at McDonald's, here we go where we had, again, this consolidation sideways right where the previous wave 5 was. We've broken above that level. Looking at the 10-day moving average, we're kind of just hugging right along. Looking at the DMI, this looks like a pretty, just nothing flashy about this, a bit of a conservative move to the upside here out of Accenture. Kind of hard to not pay attention to that. I'm just going to look at the options real quick and see what they look like moving forward. August, September, then we jump to November. September doesn't have a whole lot of liquidity, open interest, which is interesting. November has quite a bit more, so it probably would behoove the extra days, even though it might be slightly harmful on the delta and gamma to go that far out. The liquidity and the width of the spreads would make up for it because the spreads they're a tiny bit wide, but they're much better going out to November. And then you have the extra time. So hopefully the stock continues to churn to the upside and maybe doesn't take off and run like a scalded rabbit to get there. We just continue this. And here's that 45-degree angle that I was talking about. So we've already pulled up a few examples of what it's talking about. BABA with the 10-day moving average, and then here's a good one, ACN with the 45-degree angle. You can see that there's been a few corrective moves there, but nothing of significance. It doesn't have those really hard downward corrections like stocks that go vertical do. The stocks go vertical, they correct back hard to the downside. The 45-degree angle ones don't. You still have your down days, but not the heavy, hard corrective moves. So kind of tough to ignore that. Trading at 222 with a potential target right at 250, somewhere between 240 and 250 would be the expected move there. The only negative being there hasn't been enough of a corrective move here to create a zigzag, so that wave 4 could start any time. That means that we need to put a lot of weight in the DMI as far as confirming the strength of the trend. Good separation between the directional indicators, the ADX breaking above 25, which is even the more conservative target on the ADX. We covered that in the trade scan series as well on our confirming indicators. I like to look at 20, slightly more aggressive, but if you read information on the DMI, you're likely to hear about the ADX breaking above 25. So even if you want to be more aggressive or even stay more conservative, it's still above either of those levels. So that looks pretty darn good. So now let's go ahead and take a look at McDonald's, and then we'll make our decision from there, and I'll answer any questions that we may have left. Look at let's go ahead and look at the DMI now. You've seen the process before. Normally what I do is I take all those indicators off, and already knowing that it has to qualify into what I'm looking for or we wouldn't have had a result on the screen, I look at the Elliott wave pattern then, and then based on the analysis of like what we just did with Accenture, then might bring the DMI back up and see, all right, how good does it look? I mean, is it barely within the trigger mechanism, pardon me, or is it a really strong looking DMI? And in this case, look how early this is. I set this, and again, you learn that in TradeScan. I set this search to where when the ADX is rising and it breaks between the two directional indicators, that it shows up after it breaks above 15. We don't enter a position until it breaks above 20. But if you just put that as a filter in the search, then you're going to get 25, 28, 30, 35. You're going to get somewhere the ADX is basically already showing you that the strongest part of the move is over and it's too late to get in. What I like to do is set it where it's a little bit lower, and I can put a stock on a watch list and keep an eye on it. And then if it continues to look this good, which it looks great right now, there's really good separation between the two directional indicators. The positive directional indicator is moving up. The negative is moving down. The ADX is breaking above the negative directional indicator, moving in the right direction, but we need it to break above 20. That's key, because remember, that's already an aggressive level. 25 is the conservative level, so 20 is already aggressive. If you entered now, you'd be super aggressive based on what the DMI is showing. So what you do is you keep an eye on that and you look at it over the next couple of trading days. Does this separation between the directional indicators continue? Does the ADX continue to the upside? Does it break above 20? Now we have a different picture. Now the DMI is giving you an entry signal. So we come back here and look at the Elliott wave pattern. Not as good a looking Elliott wave pattern here, but that could be a zigzag right there. So we completed a wave 5 pattern here, roughly the 62% fib extension level. So that makes a lot of sense. Then we pulled back down and we look to be creating a zigzag here. Now note, we have not retraced to the previous 4 yet, which is what's supposed to happen when a wave 5 ends. So what are we seeing here? Is this telling us that the wave 5 found resistance at the fib level, bounced down, and we're going to go up, and the wave 5 is not done? We'll make a new high, and the wave 5 will relabel over here, and we're going to head up to the 100% extension? That could happen, especially since we didn't make this move down. So then I would want to look at our zigzag tool here and see, is this, there you look at that, 61.9. That's pretty darn close to 61.8, wouldn't you agree? And so that gives us a 100% extension, which we've already reached. So the zigzag pattern has already fulfilled itself. So what this zigzag was supposed to do, we're right back here at 184, it was telling you, the zigzag was telling you, you're going to go to 192. Well, we did. And we've been trading there pretty much the last week. The last 5 trading days have been right there. Now what we want to know is, are we extending? Is this wave 5 extending? Or excuse me, let me be specific. Is this C wave extending to the 138.2, 161.8, potentially maybe down the road, 261.8? That's way ahead of things. And we still have this gap here. Here's an island reversal where Gilligan was stranded for much longer than what the market did. I've been joking about that with the island reversal that we talked about in the S&P. If we go back and see, there we had an island reversal, but it didn't move to the downside like it normally does. That's what usually happens with an island reversal right there, where you get it appears maybe the coronavirus has gotten into my internet. Sorry, I couldn't resist that bad. But I am here in Florida, so who knows? It's everywhere, according to the news. But I'm not sure exactly where I dropped off, but what I wanted to share here with McDonald's was we're at the 100% extension. We want to know what's the likelihood of this becoming an extended C wave, the fact that the C has already done what it's supposed to do. The zigzag pattern has fulfilled its price target. Everything's done exactly what was supposed to happen. Are we going to 138 or 161? You look at the DMI, we can't trust it yet. We have to break above 20. So that goes on a watch list. So what it narrows down to me is that we have a really potential good look at BABA or ACN. And either one of those makes a lot of sense as far as potentials for the next week. So I think it boils down to, you want to be more aggressive, because I think Alibaba is a more aggressive trade. Looking reminder of where the DMI is there, or do we want maybe a little less stress involved, a little calmer, just a nice steady move to the upside out of ACN? That becomes a personal preference thing there. And we already have Alibaba as an alert for our subscribers, so because of that, I'm going to pick ACN here, which we've had alerts on in the past for our subscribers as well. But I'm going to pick ACN for our case study consideration for this week with TradeFinder. Alibaba will keep an eye on that one as well. As I said, it's already an alert for our subscribers. So we'll go with ACN. That way we can take a look at both of them. So we've got about 10 minutes left. So I'm going to see how many questions that I can get through during this 10-minute window, and then we'll wrap things up for this week. I hope we're not trying to make light of the virus. I'm really not. If you have any friends or loved ones that are sick, I don't want it to come off as I'm being flippant about it. It's just real and serious thing. But at some point in time, you can't live your life in fear or stress every single day, or what's the point? So hopefully that didn't come out wrong, making the jokes about it. But with that said, does Rob use ProfitSource to look at live data during the day when the alerts are sent out? You can get a live data feed. I use a 3-minute chart for looking at what's going on during the day. And primarily, the indicator that I like to use for the short term is the CCI. That's a really good indicator. I mean, it is scary good intraday of overbought, oversold. As you get that CCI showing you overbought on a 3-minute chart, stock's getting ready to reverse. Now, it may not be a massive reversal, but it's going to reverse enough to change the pricing of the options. I do pay attention to the DMI intraday. We have our Elliott wave pattern based on our daily charts. So I'm not going to make an alert decision. The Elliott wave pattern is end of day data. So you don't have to have live data. I want to make sure that you're clear on this. You don't have to have live Elliott wave data in order to follow along with what we do. I utilize the 3-minute charts for trying to, and once a price target's hit, we're talking about 10 or 20 cents maybe out of an option price or a spread price, whatever, an alert total price, still trying to get the best price of the day. So I'll utilize the 3-minute CCI and DMI to try to help time those. And quite often we do really, really well based on using those things. So hopefully that answered your question. What do I think of a butterfly? Julianne, what do I think of a butterfly on the SPY? Going back to the SPY, I like to do the out of the money butterflies. As you know, sometimes they're challenging on the market itself. It's just more difficult, I have found, timing wise on the SPY versus individual stocks. As you know, if you've followed me in the past, that time is the one thing that I've not been able to really find a system that I'm very clear on within Elliott wave time. Pricing, the patterns, etc., are great. It's the time aspect that I've struggled with. And so that makes doing an out of the money butterfly on the SPY just a bit more challenging. But I mean, I hear what you're saying. We're breaking to the upside here. We know where the target is. We've got basically 2 signals telling us, we're likely to break somewhere above 340 on this area, which is that previous high, probably moving up to 350. You could clearly set a 340, 350, 360 out of the money butterfly. But what month do you utilize? So that would be the challenge there. But a very good question. And certainly a viable trade alternative, but that's where the problem is. ENPH. In phase energy. Yeah. This one's a dichotomy. So for me personally, I would stay away from this. Here's the problem. You have a DMI that's telling you that this move to the upside is strong. The wave 4 has disqualified. So this downward Elliott wave pattern is no good. That's been disqualified. So if you absolutely had to make a trade on this, then you would look to make, okay, we're going to correct that wave 4 impulsive move because the downward zigzag became disqualified. So normally when a pattern becomes disqualified, you retrace the previous impulse. So the impulse here was down, so you retrace that back. The DMI would be supportive of a move back to 70, but that's really trying to, you know, pick a potential move, make a trade out of something. I would much prefer to find trades that fall clearly within all the indicators rather than saying, well, you can make this make sense type of thing. And then the other one was BRKB. So amazed at how many people look at this. Berkshire. Not really an Elliott wave pattern. You look at the DMI, looks like it's starting to get interested, but it's too early. Barely breaking above the negative directional indicator, but not above 20 yet. There's separation between the two. It's one you could keep an eye on, potentially a move here where you could make a case for it moving all the way back up here to 230, but again, you're kind of making a case. But regardless of that, as of right now, with the indicators that I look at, it's a do nothing because we need that ADX to break above 20 first before you consider doing anything. So it could be a bullish watch list trade, but that would be it. Question? Yeah, I was in Des Moines back in the 90s. So if you were there, great memory. Question on Microsoft, Mr. Softy. Let's take a look here. Wave 3 to the upside, looking at the DMI. This part of the move was very strong through here, which the ADX, here's where you get value out of the DMI. The ADX moved outside of the positive directional indicator, right exactly when the upward part of the momentum in the wave 3 stopped. So basically what the DMI and the ADX was telling you is that, hey, this move is strong, but the strongest part is over. That doesn't mean that the entire move is over. It means the strongest part is over. Now the positive directional indicator has broken back above the ADX, indicating that there could be some more move to the upside here out of this wave 3, but it wouldn't be out of the realm of possibility for it to break down to the wave 4 either. So I would think this would have a lot to do, Microsoft would have a lot to do as far as following along with the market. If the market continues this break from the wave 3, and again, we need the follow through day tomorrow, if it continues to do that, then I think you can make a case for Microsoft to maybe continue this move up towards this wave 5 target. It's at 208, potentially 228, 230 area, but that's not the greatest sign of strength out of the DMI as far as future movement. It's telling you that the move to this point was very strong, if that makes any sense. Is it possible for the SPY to have a truncated wave 5? I don't think we have evidence of that yet. I think the next couple of days are going to tell us an awful lot on the SPY. And then once we get that next day or two in there, then I'll come back and I'll do another S&P recording and we'll update that move. There was a question about the displaced moving average. I'll make a note of that, Michael. I don't think I give it enough. I would give it enough of its due to just touch on it right now. If there's other questions on, so I'm just going to make a note here. If I just try to show it to you with just a couple minutes that we have left, I'll spend a little bit more time on it next week. And who knows, maybe based on whatever the market does, market could give us an indication of it. But I can show you the displaced moving average, again, just as a quick reminder, is it takes a very short-term moving average, so it's showing you short trends, and then it takes that data and says, if everything stays the same, where would that be in the future? And most people look at a 6-4. So you're looking at a 6-day moving average displaced 4 days ahead. So if everything stayed the same in a 6-day moving average, where would that moving average be 4 days ahead? And if the stock is broken below that level, that could be an early indication that you're moving into a corrective move. So in general, that's the answer to the question. But to show you examples and stuff, I'll do a better job of that next week for you. It's a pretty interesting indicator for those that are interested in corrective patterns. Did I discuss AXP? I did not, but I can. American Express. We came down to this wave 4. We hit 55% level. It's bouncing to the upside. Looking at the DMI, this is clearly showing you the ADX is saying, yeah, we have no faith whatsoever in this becoming a wave 5 move to the upside. And you have to look at where the pattern is now and respect that currently, but there's no confirmation whatsoever from the DMI that we are going to continue up and make a wave 5. I think the more likely scenario move here is that we found some support down here after this move lower. We filled this gap, we've bounced a bit, and then we're probably going to see a move down and likely back down here towards that March low. I think it's a likely scenario there. But until then, you respect what the Elliott wave pattern is showing at this point in time, just understanding that there's no confirming indicators going along with it at this point in time. So it has to label the data that it has, but that's why we have a technical trading system with indicators as well as Elliott wave. There wasn't a whole lot of volume, David, on ACN. There wasn't. There's some out to November that we looked at, though. SUM, we'll look at that, and then we'll look at Zebra, and then we'll wrap things up. So SUM, as you can see, is moving, and we have earnings on the horizon. The ADX is giving some confirmation to this move to the upside here. We look at this zigzag that's in place right now that shows potential move to 23. We'll see what the earnings report comes out and says. Like to see that ADX above 20 going into the earnings. So that leaves a little bit of doubt, but just still like the longer term situation. Lots of things about this, higher lows, the potential move back to the previous 5 being right there where that C wave extension is. And I know people get all sketched out when we hold directional trades through earnings, I'll say it again. It's been my experience that technicals, more often than not, nothing's 100%. Nothing's right every time. And I'm sure if it's wrong this time, you'll let me know about it. But the majority of the time, earnings reports tend to come out and the stock moves the direction that the technicals were already showing. There's exceptions to it. It doesn't happen every time, but the majority of the time it does. So I don't shy away from holding directional trades through earnings because of that. One other thing on Zebra, and then I know there's lots of questions, and a lot of you have ones that you want to look at. And as I mentioned again, we have so much time, and hopefully I'll get to your questions and the charts that you want to look at next time. But I did want to cover this one on ZBRA because it's just been a pretty good move to the upside. Really solid looking pattern with about as good of a DMI as you could ask for. I mean, when you look at that, you just see that there's a separation. ADX is breaking above 20, just setting up to where the DMI is telling you we've got some strength here. And it had a little bit of resistance today, expectedly, right at the previous 3. But the DMI is telling you we have the strength to break through that and come up and potentially hit that wave 5 target. Thanks so much for your attention. Again, I wish I could get to every single question. I apologize if I didn't get yours. Please keep viewing. Please keep asking. And hopefully I get to yours in the near future. And hopefully you found that informative. Hope you have a wonderful week. And I look forward to talking to you again next week. Take care, everybody.